Good morning. Thank you, that's my time. I appreciate you all coming. Okay, so what we're going to do in the 14 minutes that I have left on my time is that's what you get when you follow all the agency heads, is we're just going to do a brief overview. Initially, this presentation was going to be about new legislation. House Bill 1104, which was DLGF's agency bill, did not make it through legislative session. It was one of the bills that they ran out of time for at the end of regular session, and then it did not get reintroduced during special session. So the majority of my presentation died with that bill. Part of this, you can strike exemptions, it's all deductions. I was asked if I was going to talk about deductions, perhaps address some of the less used deductions and go over those. So the materials are here, you can read them, and please, if you do have questions, you certainly, you can email me or Dave Marusars, my Deputy General Counsel. He's been there for a long time and knows a lot of the answers to these questions as well. So, or I think we have a box up here. I will give my standard legal disclaimer that I nor others from DLGF will be providing legal advice to you today. And if there's a conflict between what you see on our slides and the law, please use the law. There's me. It is a pleasure. I've had the opportunity to meet a number of you, or talk to you on the phone at least. For those of you who haven't met, if it helps, I'm the new Mike Duffy, is the way that most of you are referring to me. I'm just shorter and a little whiter. So, House Enrolled Act 1323. This is one that was passed and signed by the governor. It added a new section of law to the code, which becomes effective in 2019. And it deals with heavy equipment rental excise tax. And this is really more of an overview for you all, just so that you understand some of the things that are out there. With a few exceptions, we're talking about personal property, whether it's business or personal, which is not affixed to real property. And the definition of heavy rental equipment does not include equipment that is eligible for a property tax abatement deduction in our economic revitalization area. The equipment that's subject to the excise tax is not subject to assessment, and the tax dollars that are collected are to be deposited in a new account just for this excise tax. County auditors are instructed to apportion the funds in the same manner that property taxes are apportioned and distributed based on the location where the tax is sourced. House Enrolled Act 1141, which is effective also in 2019, changes the funding formula for community mental health centers. If the county's general fund levy is greater in 2017 than in 2018, the community mental health center appropriation in 2019 will remain unchanged from this year. However, if the 2018 general fund levy is greater in 2017, the appropriation for the community mental health centers for 2019 will be adjusted up by the growth between the 2017 and 2018. Marion County, however, my home for 31 of my 40 years, is always different, and theirs will be phased in over a 3-year period. Under this new statute, community mental health centers funding will be based on the population of their service area compared to the county population as a whole. They will also be required to, the community mental health centers, that is, will be required to be certified by the Division of Mental Health and Addiction. The community mental health centers will also will be required to submit annual reports as part of their certification process to the division and also county officials. Additionally, the county treasurers will pay the community mental health centers directly at least twice a year in July and December. I'm not going to spend a lot of time on 1263, but not because it's not important or confusing. Matt Parkinson, who most of you already know from our office that was up here earlier, is going to cover that as part of his presentation this afternoon. There are a couple things I would like to point out. One, we issued a memo, DLGF issued a memo 2 weeks ago, I believe. They gave guidance on this. Expect to see a revision to that memo. The thing that the memo did not take into account was the difference between counties that have a lit council and the ones that have just a county council. So Matt will explain a little bit more of that, but please expect that probably in the next week. There's a draft of it in my inbox currently. House Bill 1104. Okay, I'm going to say this. It's on every slide for the next 8 slides or so. This is not current law. This bill did not pass. The purpose of me covering this today is just so that you all know what some of the things that were contained in it that may be applicable to auditors, or at least good for you to be aware of. But it is not current law, but you may see it in either DLGF's bill in 2019 or in another bill for that matter, because some of these things were not DLGF proposals. They were introduced by different legislators. It sets dates for county auditors to submit property tax settlements and distribution information to the DLGF. It deletes a holder of a tenancy for a term of years from the definition of owner for property tax statutes. A tenancy for a term of years is actually a lessee, thus they shouldn't be liable for property taxes. This was an oversight when the original law was rewritten 2 years ago, I believe, and then we realized that this should actually come out, so this is more of a technical change. All political subdivisions must include the percentage change between the current and proposed tax levies of each fund in their Gateway Form 3. And the purpose of that is just to ensure that the taxpayer, it's easier for the taxpayer to understand how much the change is. It's really a transparency issue. (1104) was going to allow nonprofits and other charitable organizations to file their exemption application 30 days late if they paid a late fee. This is primarily because every year the legislature was adding special legislation for a nonprofit that missed the deadline by only a few days, so this was really to cut back on that. There was a requirement that county auditors submit homestead deductions on the homestead database by March 15th of each year, which would allow for a single day where the database should be up to date, which will allow for a better overall picture of the homestead situation and whether people are claiming multiple deductions. It would repeal the County Board of Tax Adjustment references throughout the code. There isn't a county that has a County Board of Tax Adjustment anymore, so this is more of a technical change. It requires that a political subdivision filed their Form 4 not later than 5 days after their budget adoption. The sooner DLGF can acquire data that is contained in the budget, the adopted budget, the sooner they can begin the budgeting certification process. And given our reduced time this year for certifying budgets being pushed back 6 weeks to December 31st, the more time we can get with your budgets, the sooner you'll have them back after certification. It would have clarified DLGF's ability to make administrative rules for budget procedures. We have the ability, specifically laid out in code, for assessment procedures. We also have overall authority, but this was going to clarify our ability to do budget rules, which is, we're going to be looking at our budget processes over the next year or two and determining what should be included in statute versus rule versus just remain as a DLGF policy. For this first bullet, the main thing to know is that non-improvement specific deductions and exemptions, they shall be applied in the order most beneficial to the taxpayer. Again, this is not current law, and you'll work with your vendors to ensure that happens in the following year if this goes through, but that's what that is. In TIF districts and other allocation areas, property shall be assessed based on the actual use of the property. For instance, if a building is mixed use, it shall be assessed as the percentage residential and the percentage commercial. And the residential percentage shall be applied to the TIF base. A number of counties are doing this already, but this was going to codify that. Some other things from 1104. I'm actually not sure how this or why this came into play, but there was an amendment into 1104. If the Form 3 were to contain an error or admission to the rate, levy, or budget, which is less than 0.25%, that notice is valid and shall be corrected by DLGF. It gives us a little bit more flexibility so we don't have to deny. Clarifies that DLGF may adopt rules during the reassessment cycle. Previous statute allowed us to adopt rules, but it didn't take into account the cyclical reassessment. So as part of the cyclical reassessment, we can adopt rules anytime during that, but they won't take effect until the next phase of the cyclical reassessment. The next is business personal property, and we worked with the Auditor of State and State Board of Accounts on this quite a bit, leading up to failure of House Bill 1104. And the problem to be fixed was really, and most of you all probably remember this from last year, the problem to be fixed by this language, thank you, was it provided confusion regarding the allocation of the fee and penalty for businesses which qualified for the business personal property tax exemption, and the counties that adopted that, they were often charging by township as opposed to by county for the fee and then penalty if that applied, which meant that many companies or businesses that had property all over the place were getting multiple charges. So this was an effort to correct that. Expect in the very near future there to be guidance, another memo like one last year, similar to one last year, from DLGF, State Board of Accounts, and the Auditor of State. 1104 would eliminate the requirement for newly married, divorced, or folks who were newly tenants in common with someone else and are homeowners to refile their homestead deduction. This was something that went into effect, as many of you may be aware, 2 years ago. This was going to completely go away, and it was going to make those people whole who did not receive their homestead deduction due to an error of this type at the end of 2017. I'm not sure how it would, in what form it would be in a new bill, but my guess is there still will be some sort of making people whole again. So that's something to be on the lookout for. And I think part of the problem was the legislature felt that it was not intuitive to know that you have to reapply for homestead deduction because you get married. County fiscal bodies may increase the salary for the presiding officer or secretary of the county fiscal body or county executives taking on additional work. New training requirements for certain elected county officials. This would apply to you all. The requirement would mandate that newly elected official training course before taking office, and the training fund money would be able to be used to facilitate the training for the elected official, and if there's enough money left, for their designees. And then finally, in 1104, there was an interim study committee on lit that was going to be headed up by Representative Thompson. Those conversations still may take place informally as opposed to a formal summer study, but it was to look at studying new lit law, which would allow counties, municipalities, and schools to enact property tax relief tax rate and expenditure rates. And it would also look at whether taxes resulting from a referendum should be eligible for local income tax, property tax relief credits. So, I really am out of time. I'm going to skip through deductions. I will draw your attention to the first 3 slides of the deductions. I think are a listing of all available deductions, which I hope was helpful for you. I have a number of questions. The questions and answers in here, with the exception of the homestead questions. The homestead questions you'll see towards the end are ones that we received prior to this conference, in preparation for this conference. And I included those even though I wasn't going to talk about homestead. And then also, there are questions at the end of each deduction type. Those are questions that came from the ones that you all asked during or after the last auditors conference. And I wanted to include them just so everybody was aware. Let's see. I had grand plans for this presentation. How can we help? Last thing I wanted to talk to you about, get to it in my notes. DLGF is always happy to help and point local units, auditors, whomever else in the right direction to identify the applicable law and issue guidance on how DLGF will interpret the law when it's appropriate for us to do so. This slide is an effort to ensure that the auditor's offices are using the many resources available to them, or aware of the many resources available to them prior to bringing the issue to our office. Again, we're happy to help, but you have a lot of resources available to you at the county level as well. DLGF, Matt, Fred, and I especially spend a large amount of time presenting at conferences, preparing guidance memos, and preparing FAQs, all of which are posted on our website for your reference. The vast majority of your questions are addressed in those materials. If you have questions about accessing that information, I know it can be a little difficult sometimes because we have so much information on our website. Jenny Banks, our communication director, is sort of the custodian of the data on the website. So give her a call and she might be able to help you, help facilitate tracking down something. Ask around your office. Many of you have good internal controls or are small enough where everyone always knows what's going on because you all sit within 30 feet of each other. So they all know what's going on and can answer those questions. However, auditor staff often email DLGF and it's clear that they have not inquired with the auditor themselves or their senior staff and email DLGF. So take advantage of your internal resources. Additionally, you have access to 2 excellent resources who are here today, an AIC and the Auditors Association. Very likely they've seen all of these issues before, or they have recognized that it's an issue for everyone, and they have already engaged with DLGF to try to come up with a solution for the masses. So those are 2 other good resources for you as well. And then finally, contact your local attorney. I understand some counties have better access to their county attorneys than others. The difference between your county attorney and Dave and myself is that they can actually provide you with legal advice. We, in the legal division, we only represent DLGF. We can't ethically provide legal advice, or financial advice for that matter, to anyone except for our client. We can point you in the right direction, help you identify the applicable law, and answer as many questions as we can, but we are not a substitute for the legal advice that your local counsel can provide. One other point, attorneys are only advisors. The ultimate decision of how to apply the facts to the law lies with the elected official. I had a question the other day, and the caller said, so I can tell the taxpayer that you and our county attorney approved the auditor to do X. And I said, no, I think it's a good idea to listen to your county attorney and DLGF, but ultimately, we are just advisors, and the final decision lies with local control. That's all I have. Well, I have a lot more, but that's all I have time for today. So please, if you have questions or need anything else, don't hesitate to leave the questions here or email them to me. Thank you very much.